Welcome back to Making Money Matter, ladies and gentlemen. I've asked Keith Bowes. He is the Managing Director of Lotus Resources. We're back to uranium. The ASX code is LOT, lot. So we've got lots to talk about today. Excuse the pun, bit of fun. I haven't spoken to Keith for over a year. And the reason I've asked him on to the program today is when I last spoke, they had a project in Malawi, but now they've made an acquisition which is in Botswana. So I want to unpack that because I've got a feeling that the market may not fully be aware of the value of each of these projects. So I'm going to let Keith give us a brief overview, and then we're going to get stuck into some of the numbers, values, and what they're going to be doing for the rest of 2024. Keith, great to see you. Thanks for coming onto the channel.
Thanks very much, Kerry. And it's great to be back again with you.
Oh, thank you. Well, first time on Making Money Matter. So give us a brief overview of who are Lotus Resources.
So Lotus Resources, as you said in your introduction, it's a uranium company. It's an ASX listed uranium company, but it has its assets over in Africa. And as you said, the first asset that we acquired as a company was the Kayelekera uranium mine, which is located in Malawi. We acquired that from Paladin Energy back in March of 2020. Kayelekera is a past producing asset. So it operated between 2009 and 2014 and produced about 11 million pounds of uranium during that period. It shut down in 2014 due to economic reasons. So if anyone remembers what happened to the uranium price in that period, post GFC, post Fukushima, prices crash all the way down to like the low 20s or something like that. Kayelekera's operating cost at that point in time was $36 per pound or thereabouts. Obviously, unable to make any profits from that, put the plant into care and maintenance with the expectation, as I think the rest of the market had at that point in time, that the uranium price would recover relatively quickly and they'll be able to turn that project back online again. As we've known now, that uranium price has taken a lot longer to recover. And it's only really in the last 6 to 8 months or so that we've seen a significant increase in that uranium price. And it's now at a level where we're very, very comfortable to turn Kayelekera back on again. So that's our primary asset, and that's certainly where we're putting most of our focus at the moment and where we're spending most of our money. But the second asset which we've got, which we're really excited about, is the Letlhakane asset. So this is a project in Botswana, a uranium project in Botswana, but it's a greenfield project. So it only has exploration done on it so far. It does have some studies, some technical studies associated with it, and it does have a mining license. But what we really liked about that project was the scale of the resource. So on acquisition, according to the previous owners, their mineral resource estimate was 190 million pounds. Now you compare that to Kayelekera's resource, which is around 50 million pounds. This project is 4 times the size, or potentially 4 times the size of the Kayelekera asset. It's also located in Botswana, which is a fantastic mining jurisdiction. And if your audience follows the Fraser Index, which is published every year, Botswana always comes out as the #1 mining jurisdiction in Africa. And in fact, for last year, it was ranked the 4th best mining jurisdiction globally. So only Saskatchewan, WA, and Utah in the USA were considered to be better mining jurisdictions than Botswana. It's a great place to be able to develop a project, has fantastic infrastructure. There's power, there's water, there's road, there's rail, and everything right next to this mining lease boundary. So from that perspective and from a development perspective, it ticks a lot of boxes.
You said it's interesting that Kayelekera is 50 million pounds. This one's 190 million pounds, and that's from the previous owners. How did you get your hands on it? Why did they give it up if it's potentially such a good asset?
Yeah, I mean, when we started negotiations, so we completed the deal in November of last year, but the deal itself took about 10 months to complete. So when we initiated the discussions with Letlhakane, or with ACAP, which was the company that held the Letlhakane project, the uranium price was still in the doldrums. It hadn't increased, it was sitting in the low 40s or something like that. The company, the ACAP company, was struggling to raise capital in that market. It had a market cap when we started the negotiations of around $50 to $60 million of market cap. And just to do a quick maths on that, that means it was valuing the pounds in the ground at 25 cents per pound.
Wow. Okay.
Which you cannot explore for that price, I can tell you that. So from that perspective, as I said, they were struggling to raise capital. They were also in a position where they had, and this goes back to some of their history around their financing, they had a Chinese shareholder that owned about 38% of the register. And Australians in general don't seem to like that. And I think that was one of the other reasons why they struggled to raise money. Because of that, they had a relatively lean team, and the project was actually being managed by, let's say, their non-exec directors and all that kind of stuff. They didn't have a real strong management team in place to be able to drive the project forward. Recognizing that, when we approached them, it was a relatively easy conversation. They recognized the benefits that we could bring. You know, we've got a dedicated management team. We've proven we can raise capital in the market when we need it. And they could see that that was a good job or good opportunity for their shareholders to become part of a much wider group that has got earlier exposure to uranium production through Kayelekera, but also maintains a longer-term exposure to the uranium market through the Letlhakane project.
So did you take over ACAP? So what's happened to ACAP Resources and the shareholders?
So it was a scheme of arrangements. So it was effectively a merger, so a scheme of arrangements. So the ACAP shareholders received Lotus shares for the ACAP shares that they had, and ACAP has effectively been delisted and absorbed into Lotus. So as part of that transaction, none of the directors, or as I said, the exec management team came across from ACAP, although we did keep their Botswana team. They've got a very, very good Botswana team, geologists. They've got some community and government liaison guys there as well, and we've kept on all of their Botswana people.
You also said a moment ago that on the register for ACAP, there was a Chinese investor with 38%. Still involved?
Still involved, but of course diluted down. When we went through the scheme of arrangements, he's diluted down to about 7% now.
Okay.
I've spoken to him on a number of occasions. He's very, very supportive of the strategy that we've implemented. He's expressed no interest in selling his shares whatsoever. And to be honest, he's one of these multi-billionaire Chinese guys. He's probably the $50 or $60 million that he's got invested in Lotus is probably pocket change for him in some way, I would think. He's also indicated to us that he won't be participating in any raises going forward. He's happy to be diluted down as we go through the process.
Oh, speaking of raises, at the moment you've got some cash in the tin. What I want to know is, with this acquisition of Letlhakane, how'd I go? Did I get it?
Very good. Yes, that's it.
Excellent. What use of funds? Where are you at with it? Because you've now got two projects, and I guess my question is, Kayelekera, when I last spoke to you, there was a lot of focus on that and getting that back up and running. And I do want to make some mention of that as well, because why would you buy another asset? Sorry to be blunt, but why would you buy another asset when Kayelekera was keeping you pretty busy the last time I spoke to you?
Kayelekera is still keeping us very busy, and it is by far our major focus at the moment. But just to go into the history of why we decided to do that acquisition. So I think when the last time we spoke, we obviously spoke about the feasibility study that we put out for Kayelekera in August of 2022.
Yeah.
Feasibility study, I think, really showed some of the technical skills that our group can bring to projects, and we were able to demonstrate that we could drive down the operating costs compared to its, when it operated previously, through things like connecting to the national grid, through things like better acid utilization, bringing beneficiation into the process and all that kind of stuff. So we're able to demonstrate a strong project, but Kayelekera as a project has only got a 10-year life of mine, of which really it's the first 7 years are the strongest years, with the production rate of about 2.4, 2.5 million pounds per annum. In year 7, we've depleted all of the ore from the pit. And for years 8, 9, and 10, we're actually treating lower grade stockpiles. So our production profile drops off towards the end of that schedule. Now, when we put out the feasibility study, the questions I was getting from people is they were happy with what we've done with Kayelekera and the costs and all that kind of stuff. But was there an opportunity for us to be able to extend that life of mine? Could we get to 12 years? Could we get to 15 years or something like that? So we had done some exploration work, specifically on the Kayelekera mining lease. We'd investigated extensions around the existing pit. We'd drilled out a couple of other anomalies that we saw on the mining lease, but really couldn't come up with anything that was substantial. Maybe we can add an extra £1 million, or maybe it's £2 million to the existing Kayelekera resource. But we're not going to find another 5 years of production from from the mining license at Kayelekera. There is some other opportunities for us. We do own some exploration tenements in Malawi as well, specifically one called Livingstonia, which has got a small resource on it. It's about 4.8 million pounds of resource on it. There is a potential to grow that. That could become a satellite pit in the future where we set up a small mining operation there, put in a small crusher, implement the beneficiation process we have at Kayelekera, which is ore sorting, to produce a physical concentrate that we then truck up to site. We could do that, and that could have a potential of extending the life of mine. But while we were doing that, we also went and had a look around to see if there were any projects out there that sort of fitted our profile in terms of being able to extend the life of production, let's say, of the company itself, rather than specifically Kayelekera. And that's where we came across Letlhakane. It sits in a very similar type of ore body as Kayelekera. It's on the same Karoo sandstones. So we believe a lot of the information, or a lot of the learnings that we've had at Kayelekera will be directly applicable to Letlhakane. And we saw a lot of synergies that we could potentially have. Botswana and Malawi are not that far apart. I mean, there's no way.
I was going to ask that. Yeah.
You can't ship or truck ore between the two mines. It's too far to do that. But there's certainly an opportunity to, share resources between them. I'm talking about people, or, spares holdings, or whatever it is, or something like that. There's definitely synergies between those two projects. And we saw the two of them fitting in really well together. So we can see Kayelekera starting up relatively soon. We're very much focused on getting Kayelekera up and running as soon as possible. We know there's still some technical work that has to be done at Letlhakane. We're going through a scoping level study at the moment around the mining activities. We've got an infill drill program going on at the moment as well. But what our sort of longer term view is that we get Kayelekera up and running, and we start to use some of the profits generated from Kayelekera to fund the development of Letlhakane. Kayelekera, we're targeting getting Kayelekera up and running by the end of 2025.
Okay.
Our current thinking at the moment is Letlhakane could be up and running by 2029, sort of 4 to 5 years to go to get Letlhakane up and running. But we will be generating cash from Kayelekera to be able to develop that project. You now put these two projects together of Kayelekera's 10-year life of mine, and we think Letlhakane is sort of a 15 to 20-year life of mine. That means Lotus as a company will be producing uranium for the next 20 to 25 years. And I think that's a story that all shareholders and investors would really appreciate.
That was a really good summary. Are you able to give us an idea, if you like, of the sort of the cost of extracting from Kayelekera? These names, I'm going to call it the K and the L. The cost of extraction from Kayelekera, because what's the current uranium price as I speak to you?
What price today? If you look at the spot price today is $85.50.
Okay. So what's the sort of cost of mining at Kayelekera?
So according to our feasibility study, and as I mentioned, it's 2 years old, but we are doing a feed program to update this. Our feasibility study quoted a cash cost of between $29 and $30 per pound.
Okay. And that's less, is that less than the previous owners? Because I think before you said it was 36. How have you got it down to 29?
So there's a couple of, we did a lot of technical work after we acquired Kayelekera, and there's some really simple things that we've implemented that have had a big impact on those costs. And the simplest one is probably connecting the plant to the national grid. So when Kayelekera was operating previously, it operated off diesel gensets. Anyone in the mining industry knows that a diesel price of between $1 to maybe $1.20, diesel power costs you about 38 cents or 39 cents per kilowatt hour. As I said, we're going to connect the plant to the national grid, but we're also incorporating some solar, some battery, using waste heat from the acid plant to generate electricity and all that kind of stuff. And we've been able to bring our average electricity price down to less than 10 cents per kilowatt hour by doing that.
Wow.
Now, if you go back to the $36 per pound that Kayelekera was operating at, 25% of that $36, so $9 per pound, was electricity, was their power costs. When we've reduced our power costs by 66%, we've taken $6 per pound directly off that cost, and we haven't done anything else other than connect to the national grid. So we've gone from 36 down to 30 without doing anything, really. All we've done is connect to the national grid. At the same time, we've also done stuff around acid, improving our acid utilization within the plant. We're putting in acid recovery systems. Acid is the second highest cost in that project. It costs about 20% of the $36. So sort of $7 per pound is associated with acid costs. We've been able to reduce our acid consumption by 25% by putting in the acid recovery system. Again, we're talking about dollar per pound coming off this price. Ore sorting, increasing the average grades of the material being fed into the plant also benefit us in terms of our operating costs. The mining costs, when we look at those, obviously there's already a lot of pre-strip that's been done in the mining. The strip ratio is only 1.8 for that mine now compared to when they start. So of course, our mining costs on $1 per ton of ore have also come down on the back of that, pre-strip already being done for us. So we've looked at all these different things in terms of how we can get these costs down. And it's really, as I said, it's the power and the acid that have had the major impact on it. But other small things we've done have also been able to reduce those costs as well, moving forward.
It sounds good. Now, Keith, one of the things that I also like to talk to people about is that the commodity space. And you said that the previous owners for Kayelekera, and sorry, for Letlhakane, it was when the uranium price was quite low, and the same with Paladin, they put it on care and maintenance. What's your view on the current? You said the spot price at the moment, 85.50. What's your thoughts? Because I know that this is an area, this is your focus. Tell us, tell my audience what you think where the future lies.
So I think there's two things you need to have a look at when you're looking at the uranium market. You need to look at the spot price, and that's what everybody quotes. I mean, everybody in the financiers and traders, whatever, they always talk about the spot price. And the spot price has been moving sideways for the last couple of months. It peaked in late January, early February at $107 per pound, came down post that, went as low as about 82 or something like that, but it's been hovering between 82 and say 90 or 92 for the last few months, basically moving sideways. But the other part of the market that I think people need to look at is the term price. So the term price is a little more opaque, is a bit more difficult to get information on, but it is quoted by companies like TradeTech, like UXC, which are price publishers of the uranium price, and they quote it on a monthly basis. So the term price is sitting at either $79 or $80 per pound, depending on if you're looking at TradeTech or UXC. But that term price has consistently moved upwards since the beginning of the year. It started the year at $68 per pound. We're now sitting at $79, $80 per pound. And why I talk about that as being so important, when we go out and look to sign contracts with utilities, it's that term price that we look at and that the utilities look at in terms of defining what pricing mechanism that we're going to be signing up for. So even though the spot price has been pretty, as I said, moving sideways over the last couple of months, that term price has continued to increase every single month since the beginning of the year. And that's what gives us a lot of positive feelings about the market moving forward. I think there's a couple of other things I'd comment on as well. If you look at, so again, looking at the two different markets, the spot market accounts for a relatively small portion of all of the uranium traded in the world. It's the term market, which is predominantly dominated by the utilities, that makes up 70 or 80% of the trading that goes on in the uranium space. Now, last year, if you look at what the volumes that were traded in the term market, it was about 160 million pounds of uranium was traded in the term market last year. There was one very big contract between Cameco and Kazatomprom that accounted for 55 or 60 million pounds, which was a bit of a blip in the system. But even if we ignore that, it's 100 million pounds. To date in 2024, only 30 million pounds or 32 million pounds has been traded, which is quite shocking, actually, when you think about that, especially when you think at the levels of inventory that the various companies have. The expectation was that this year would be a bigger year than last year. So sort of what people are thinking is that maybe the second half of 2024 is going to be the real strong period in terms of signing of contracts and all that kind of stuff. And that's sort of what we're expecting to see as well. We're expecting to see the amount of what they call requests for proposals or the off-market discussions that we're also participating at the moment are really going to start to increase towards the second half of this year. And we've started to see some of that already in that our team went and attended the WNFM Uranium Utility Conference in Georgia at the beginning of June. And there was a lot of interest from North American utilities there about talking to Lotus, wanting to sign agreements with Lotus and all that kind of stuff. So the team met about 12 or 14 North American utilities during the 2 days in which they were in Georgia. And there's a lot of follow-up conversations happening now on the back of those meetings. So we're already starting to see that increase that we were expecting in terms of the utilities looking to sign more contracts in the second half of the year. So we're very, very encouraged by what's happening in the market, even though as an observer who's only looking at the spot market might not see much happening. There is a lot going on in that term market, the term prices going up, the utilities are getting more interested in signing on new suppliers. Because one of the other things that we've also seen in the market as well is that a North American utility generally historically would have looked to either Cameco or looked at Kazatomprom to be able to get their production. Those are the two biggest producers in the world, and that's where the North American utilities were getting most of their production, and they were pretty confident that every year they'd go out and just sign contracts with those companies. The problem you've got at the moment is that Cameco and Kazatomprom have sold or forward sold all of their production for the next 4 to 5 years. A North American utility who approaches Cameco or Kazatomprom now and asks for delivery in 2026 or 2027 is going to be told there's no production available for them. They need to go and find other suppliers to be able to deliver into their needs. And that's why we believe they're looking at companies like Lotus to be able to get Lotus back up and running so we can start producing uranium so we can deliver into their contract book.
Would any of those utility companies look to help you with the funding of the project going forward to secure supply?
Yes, there is. So I think there's been a real shift from the utilities over the last year, and that I think not only have the utilities now begun to accept that they need to pay the higher prices. I think a lot of utilities were expecting, this is going to be a bit of a price spike. It's going to go up to $80 or something like that and come back down to the 60s or whatever it was. I think the utilities have now accepted that that's not going to happen, that, an 80 or $85 dollar price, at least in the spot market, is the floor out there. So they've accepted that now, but they're also beginning to appreciate, again, as I said, because of, I think, some of the conversations they've been having with Cameco and Kazatomprom, what else can they do to encourage companies to bring their projects back online again or start up greenfield projects? And certainly a prepayment, which will be helping the financing of the project, is one way that they can do that. And there are a number of North American utilities have expressed an interest in negotiating something like that.
Okay.
So there's definitely conversations going on about how they could potentially do that. Now, each contract itself is probably not going to be a huge amount of prepayment, whether it's, 10 million or 20 million US dollars, not large amounts. But if you could get 2 or 3 of those companies together and raise 30 or 40 million US dollars, that's a very, very significant portion of our initial capex. Because we, according to our feasibility study, we're looking for $88 million.
Okay.
In terms of upfront capital. There's pre-production and working capital on top of that as well. But still, $30 or $40 million worth of prepayments from utilities is a significant portion of the amounts of money that we raise and would make a big difference.
All right, let's, we don't have a lot of time left, and I just wanted to ask you this quick question. With your project, so currently your market cap's about 650 mil, right? What's the value? Because I'm looking for, again, for the audience of where's the shareholder value. So with Kayelekera, what sort of a value do you put on that? And what sort of, can you explain a little bit of that to us and Letlhakane?
Sure. So, I mean, we're obviously of the opinion that our share price, we're undervalued at the moment. It's certainly our opinion. I'm sure every single CEO that ever gets onto a show says they're undervalued.
Yeah, of course they do.
But I mean, when you have a look at what we've got, so we've got a Kayelekera project, which has got a 10-year life of mine, producing circa 20 million pounds of uranium during that period. It's got a very low capital to restart. It's going to be very profitable when it comes up and running. You compare that against, say, let's talk about Boss Energy as an example. Boss Energy's market cap is $1.8 billion. Okay.
Yeah.
They've got a similar sort of production, 2.4 million pounds per annum. We're also around that 2.4 million pounds per annum. They are in Australia and South Australia. They have started up. They have raised their capital and all that kind of stuff. But if you just look at Kayelekera and our market cap of, you said 650, and you compare that to Boss's 1.8 billion. So that's one comparison I think you could do. The other comparison that I like to do is for Letlhakane. Letlhakane is a project, so we know it's a greenfield project. There was a feasibility study done on it, and there's a lot of work we would like to do around that. But for me, Letlhakane is a very similar project to, say, either Bannerman's Etango project or even DPLO's Tumas project over there. Bannerman's with their Etango project, Bannerman is a market cap is around 400, 450, I think it is today. And we've got Lotus at 650, yet we've got a project that's similar to another one that's got a market cap of 450, and Kayelekera, which is similar to Boss's, honeymoon project at $1.8 billion. There's not a lot of value being associated with Letlhakane, is sort of our view at the moment. That's the way we think of things. And maybe one other thing I'll just talk about in terms of valuations, and this is something that's come up through the work that we did. At Letlhakane, as I mentioned, when we did the acquisition, there was 190 million pounds of resource in there.
Yep.
But when we got our geologists onto that resource model and we looked at it ourselves, we realized that what the previous owners had done, and I'm sure a lot of people do this, they were trying to capture as many pounds as they could into that resource estimate. So they opened up their wireframes, search parameters, and all that kind of stuff. We have a different view on things. We want to make sure we're focused on recoverable and economic pounds. So we've redone that resource completely. We've constrained it within a pit. So it's this, this realistic prospect for eventual economic extraction. Yep. And our resource has come down. We're only quoting 118 million pounds now. But that 118 million pounds we know is recoverable, we know is economic. And if we apply the metallurgical recovery factors coming out of the feasibility study that the previous owner did, that project could recover 80 million pounds of uranium. So again, you do some comps, that's 4 times bigger than Kayelekera. But what I think is a really interesting comp, and I know there's a difference in terms of the projects, but Paladin's Langer Heinrich project for their 17 years recovers 77 million pounds. Letlhakane could recover 80 million pounds. So that sort of gives the audience an idea of the scale of what Letlhakane could be moving forward. And again, as you mentioned, is the market placing the right value on Letlhakane? My answer to that would be no, they don't. They haven't quite got an understanding of just what the size and the scale of Letlhakane would be moving forward. Okay. And that's one of the reasons why we're putting some effort into that now, why we're spending money on infill drill programs, why we're spending money on doing these technical studies, so we can show to the market exactly what the value of Letlhakane is. So hopefully we can drive up our share price and get our market cap up as well.
All right, we've run out of time. Keith, it's been fantastic. You're going to have to come back come back in a few months' time and let's unpack it. Let's focus. I'd like to do a full focus on Letlhakane, but I think today it's been really interesting just to do that comparison and also a peer comparison so that our audience gets to understand who are Lotus Resources and why right now is a pretty important time in the history of the company. But let's finish up with 3 reasons you think they should sit up and take notice. 3 quick reasons why they should take notice.
Lotus as a company has 2 fantastic assets. We're going to be a producer very, very soon. We're going to be selling uranium into a high price market. We are a company that's going to be producing uranium for the next 20 to 25 years.
Well said, Keith Bowles. Thank you so much for joining me on Making Money Matter. We'll see you again soon.
Thanks very much, Kerry.